In a recent public address, Indian Prime Minister Narendra Modi asked citizens to halt all domestic gold purchases for exactly 1 year. That same speech included 3 other specific requests: reduce fuel consumption, postpone foreign travel, and increase work-from-home practices. These 4 requests all feed into a central node: US dollar outflows. Each activity requires spending outside the domestic economy. This reveals a calculated macroeconomic intervention. Bundling gold with fuel and travel highlights the primary drivers of foreign exchange demand. When India imports crude oil, when its citizens travel abroad, and when they buy physical gold, the international markets demand payment in US dollars. This appeal functions as a preemptive Forex defense mechanism. It is an attempt to protect the national balance sheet and preserve dollar reserves before external pressures reach an economic breaking point. India relies on the global market for the vast majority of its physical gold, like the imported bars seen here, as well as almost all of its crude oil. Securing both of these commodities requires a constant, massive outflow of US dollars from the country's central reserves. Looking at this model of India's foreign exchange reserves, you can see 2 main pipelines draining the tank. Right now, escalating tensions in the Middle East are artificially inflating the price of crude oil, widening that first pipeline. Because crude oil is an inelastic necessity, the country cannot simply pause fuel imports when prices spike. The reservoir drains faster, and the government must cover the difference. If discretionary consumer spending on gold surges at the exact same time the oil bill is spiking, the total dollar outflow becomes severe enough to weaken the rupee. A growing industrial base requires an uninterrupted supply of energy. The government has no choice but to pay whatever the global market asks for oil. Paying those higher prices widens the trade deficit. As more dollars leave the country, the domestic currency loses purchasing power, which is why a weakening rupee directly follows an energy shock. In this environment, individual household jewelry purchases amplify an already stressed national trade deficit, turning a routine cultural habit into a systemic macroeconomic threat. Direct government appeals regarding household consumption are rare in Indian policy history. These statements typically coincide with specific patterns in the national balance sheet. The exact combination of expensive oil, high gold imports, and a weakening currency previously collided during the 2013 taper tantrum. This split-screen timeline compares the macroeconomic stress indicators from 2013 against today's data. You can see the identical spikes in oil prices and import volumes happening in tandem with currency depreciation. During that crisis, the rapid depletion of foreign exchange reserves triggered a severe, sudden devaluation of the rupee. Policymakers track this specific trio of indicators meticulously because the data proves how quickly overlapping import dependencies can destabilize the broader economy. The historical data indicates that public consumption appeals serve as accurate leading indicators of imminent fiscal stress. Despite the parallels to 2013, the current messaging is carefully calibrated. It is preventative management designed to avoid triggering market panic. Central banks and government leaders use verbal intervention to engineer public cooperation before external shocks fully hit the domestic market. The Reserve Bank of India needs time to manage currency flows. Preparing the public psychologically to restrict non-essential spending buys the central bank that time. Smoothing out the currency demand right now with voluntary pauses lowers the mathematical likelihood of needing draconian emergency capital controls later. Framing the request as a matter of national duty encourages compliance without having to explicitly detail vulnerabilities in the national balance sheet. The speech is a diagnostic artifact. It reveals that during periods of global instability, the government will prioritize sovereign reserves over consumer comfort. A domestic push to halt gold buying does not automatically trigger a crash in global gold prices. On the global stage, gold functions as a reliable structural hedge against the exact macro instability, war and inflation, driving India's defensive policy. This chart maps that divergence. Global markets are trending upward as investors seek safety, while domestic Indian markets immediately trended downward following the Prime Minister's speech. Domestic jewelry company stocks dropped sharply because financial markets immediately translate political appeals into concrete financial risk. Traders at the Bombay Stock Exchange price in government statements instantly. They view verbal appeals as a guarantee of incoming regulatory intervention, causing an immediate sell-off. Gold is splitting into two distinct realities. It remains a globally bullish safe haven asset while becoming a domestically restricted commodity. Based on compounding external pressures, we can forecast the specific fiscal policy actions likely to hit the market in the 2026 to 2027 window. An outright legal ban on gold purchases is highly unlikely. Blunt prohibitions are historically ineffective for major economies and usually fuel black markets. The first realistic fiscal lever the government is preparing to pull is the implementation of significantly higher import duties on physical metal. Second, we can expect tighter, more stringent import controls and quotas on the volume of physical gold allowed to enter the country. Third, the state will aggressively push sovereign digital gold alternatives. These financial instruments satisfy the demand for gold exposure without requiring the physical metal, keeping capital inside the domestic system. As seen with these customers, the cultural reliance on physical jewelry is deeply entrenched. The government's challenge is to redirect that specific physical buying behavior into financialized assets. These three anticipated policies specifically target the US dollar outflow problem. They aim to reduce the currency drain while attempting to preserve the functionality of the domestic jewelry industry. The preservation of US dollar reserves is the primary objective behind these requests. Managing these specific outflows remains a critical mechanism of sovereign defense